Welcome to Russell Investments Market Week in Review for the week ending June 28th, 2024. I am your host, Lam Galuka, and I'm joined by my colleague, Senior Director and Chief Investment Strategist, Paul Eidelman. Paul, thanks for joining. How are you?
Yeah, I'm doing great. How about yourself?
I'm doing well. I grew up in Seattle, so I'm jealous that you're there, but I am here in beautiful Milwaukee and excited to connect today. Thanks for the time.
Sure.
Well, just to dive right in, we're almost halfway through the calendar year. As we approach the end of Q2, what were some of the major themes and developments impacting markets this week and for the quarter as a whole?
Yeah, I'd say this week it's been quieter for financial markets. Both global equities are roughly flat on the week to Thursday, and we're seeing stable sovereign bond yields as well. At the margin, some of the highest flying mega cap tech stocks are showing a little bit more two-sided volatility into the end of the second quarter instead of their almost vertical or meteoric rise for most of the quarter. But on the week so far, it's been relatively quiet. I think for the second quarter in its entirety, though, I think there's definitely been some bigger themes and bigger moves in markets catching attention. Within equity markets, a lot of it's been driven by this theme around artificial intelligence, which has really helped to drive very strong returns in the US equity market, but particularly the large technology stocks where the Magnificent Seven companies are up almost 18% on the second quarter, which is a really phenomenal performance, whereas the other 493 companies in the S&P 500 index are actually down by 1% on the quarter. So a really large divergence and spread within the equity market, largely explained by this theme and excitement around artificial intelligence. And you see that in some other markets too, in the emerging markets, for example, strong performance there with a lot of it being driven by TSMC, the semiconductor producer in the emerging markets. On the yield side, it's been a tale of two cities, if you will, where yields rose very sharply into mid-April when a lot of the economic data was strong and we had some upside surprises to inflation in the United States and a number of the other developed markets early in the quarter. More recently, though, yields have been falling pretty sharply, both on the back of some sluggishness of the growth data and also some downside surprises on the inflation data more recently. And so point to point, yields are roughly flat on the quarter, but it's been a bit of a roller coaster ride as the market narrative has shifted from more of a higher for longer, no landing for the global economy to more of a softer, harder landing more recently.
Very good. And to shift gears quickly, I know one thing that's on most investors' minds right now are politics and the elections, particularly the outcomes and how they may affect portfolios and the markets generally. We're recording this on a Thursday. The first US presidential debate is later this evening, and we have elections in France and the UK in the week ahead. Which of these appear to be impacting the markets the most so far?
We're not seeing financial markets price much around the US election yet. I think some of that is November is still a ways away, and some of it as well is that the election looks to be incredibly close right now for both the presidency and Congress. And it's unlikely until we get closer to Labor Day that we'll have enough information for the markets to start to sniff out which way this is going to break and the implications of that onto financial markets. So for now, even though this debate will be an important watch point on the week, the U.S. election has not been impacting financial markets that significantly so far. I'd say of the three, we're seeing the most volatility and impact from France onto global markets so far, where Marine Le Pen's party, a populist party in France, is polling very strongly in the data going into a first round of National Assembly elections this weekend in France. That's caused a sell-off in French stocks relative to their counterparts in Europe, and also a bit of a widening out where French sovereign bond yields have moved up higher relative to other government bond yields in Europe, like the German sovereign bond market, for example. And so a bit of a risk aversion and anxiety trade there happening in Europe around which way these French elections will break in this weekend and the second round the week thereafter.
Thanks so much for that insight. And one thing I've heard from many trusted colleagues within Russell Investments is don't let your politics affect your planning. And that's something that we've really embraced here. Can you expound on that a little bit, as some investors may be a little bit fearful of potential outcomes?
Well, one of the things we find in our data going back over several decades is investors have a tendency to move into cash around election years. And that can actually harm portfolio performance. If you look at financial market results over many election cycles, you tend to find that equities do well in election years, regardless of the outcome of political party one way or the other, based on what happens in November. And I think this theme of staying invested and trying to be unemotional and dispassionate with investment decisions is really a key to success over the longer term for our clients.
Perfect. Thank you for that, Paul. Now, to wrap things up, one topic that many investors and financial professionals are asking about is where the markets are headed in terms of that dreaded R word, right? The recession. I know that Russell Investments recently put together a Q3 outlook that addresses these concerns. Can you tell me a little bit more about that?
Yeah, so our global market outlook is titled the three scenario problem, which goes through the key drivers of what is very high economic uncertainty right now in terms of the outlook. As a baseline, we think it's a little bit more likely than not that the US can avoid a recession in the year ahead, but there are key areas of uncertainty and risk around, particularly how high borrowing rates from the Federal Reserve are impacting and hurting parts of the economy, including some households and some businesses that are more prone to those high interest rate conditions that are still leaving some risks.
Absolutely. Well, Paul, thank you so much for the time and for the insights. That has been our Market Week in Review. Thanks for watching, and we'll see you next time.
Hi, I'm Sophie Antel-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.